it. Good afternoon, everybody, and welcome to the July market update. I'm Cindy Bishop with Cindy Bishop Worldwide, and I want to introduce Mike Ott today, your presenter. For those of you that don't already know Mike, he is a former public school teacher, and he has been in the mortgage industry. We're going to just start saying for a lot of years. You know, for those of us who have been in the business over 30, over 20, right? Exactly. Yeah. You know, what can I say? With his educational approach and exemplary business reputation, Mike is loved by his clients and agents, which is proven in the fact that most of his business is referral business. Mike comes to us today with the monthly market update, and I'm looking forward to this. This is Mike's first time doing this, and this is going to be exciting for all of us. All right, Mike, take it away.
Awesome. Thanks, Cindy. Thanks, everybody, for being here. Yep, that's first time doing it. So I'm excited. We're going to look at market conditions, talk interest rates, market news, and hopefully some valuable lending information today for this update. And hopefully you guys can take away some nuggets. And yeah, as Cindy mentioned, please feel free to unmute, ask questions. We're a small group. It's intimate, and I'm not offended. So ask away. All right, so let's start with interest rates. Let's just say that interest rates right now kind of stink, right? And, you know, we've had these forecasts about interest rates and a lot of optimism around rates maybe getting back down into the fives during the summer months. But they've done the complete opposite. And a lot of this has to do with the markets and investors trying to play kind of a guessing game as to what the Fed's going to do with their federal funds rate. And honestly, the markets are kind of playing chicken with the Fed a little bit. And we'll talk about the percentage of, you know, the investors and what the markets are expecting the Fed to do for the rest of the year. But really what's been keeping rates high and kind of keeping the Fed very hawkish about continuing to raise rates is the resilient labor market and wage growth. What they're trying to do by raising the rates is to kind of stifle that. And slow things down deliberately and on purpose. And the market is really kind of, you know, doing otherwise. So labor markets, surprisingly strong, despite the increases that we've seen by the Fed and their federal funds rate. But one thing that's very inflationary is the wage growth. And, you know, that wage growth, resilient labor market, and the inflation being stubborn, where it's not really coming down maybe as quickly as we all would have hoped over these summer months. The way they're looking at the year-over-year numbers, being that they were so high and peaking last summer, that we've got to be replacing lower numbers on some of this stuff. And, you know, we are, but we've got a lot of background stuff, labor market, wage growth. And then, you know, we're a global economy. We've got, we've got the other markets around the world. We've got the Russian-Ukraine conflict. All of that stuff is in the background, and, you know, kind of, there's a lot of uncontrollable things out there. But for rates, and what I typically do, and I do this for my clients, is, you know, I usually look at kind of a range of rates, right? Where have rates been trending in, let's say, the last 2, maybe 3 weeks? And the trend right now is definitely upward. And your conventional conforming loans, that's for loan amounts 726,200 and below, we're seeing, you know, 6.75 to 7.25. And on the high balance, which is the, whoops, and I see a typo there, that should be 726 and $726,001 up to $1,089,300. Same with jumbo, they're going to be in that 7.5. Sometimes we have lenders will have an outlet for a jumbo product where they might kind of be undercutting that average, and there might be some really attractive rates on some portfolio jumbo products. sometimes arms, but not too much right now. And you know, arms are so priced out of the market that they're especially in the conventional conforming arena, that they're worse than the 30-year fixed rates. Conventional, the jumbo world, again, you might get a couple investors out there that are real aggressive with their pricing. And we tend to see that, you know, larger down payments tend to yield better rates to the consumers in that jumbo space as well. VA, the government loans we got VA 6.5 to 7. FHA and USDA rates kind of trend together, and they're about 6 3/4 to 7 1/4. And I know for those of you that have been, you know, you come to the market updates, you've seen the Mortgage News Daily. I'm gonna see if I can effectively pull in this browser here so that we can see it. Maximize this for you. Excuse me, Mortgage News Daily is great for you guys because it's free, and it does a nice job tracking the rates on the products that you see there. I've left the graph on the 30-year fixed, and you know, today it's at 7.12, which is actually down a little bit. And they'll do a track for basically the previous month, and as you can see there on you know, the 6th of July, we kind of peaked up there at 7.22. Now, that's kind of a national average. That means that there's going to be some consumers that get rates above that, and there's going to be consumers that get rates below that. These surveys and this data collection, it's really hard because you're going to have some consumers that are paying discount points to lower the rate, and they never factor in the points. But I always tell everybody it's kind of safe to say that these averages, when they do these across the product range for us, you could probably expect that average somewhere, these people are going to be paying somewhere between 0.5 point, maybe 1.5 points within that average range. But Mortgage News Daily is a great site. Do any of you check this out or visit this site? This is where you can chime in.
I think they're shaking their head no.
No, well, this is, like I said, this is free, which is great because the stuff, you know, like the stuff that we get with the candlestick charts and all that stuff that lender, we have to subscribe and pay to that. Mortgage News Daily is kind of a free, you know, it's open to the public, so you don't have to be a lender to see this. They do mortgage rates. MBS is mortgage-backed securities, and this is kind of where you see the candlestick charts. Let's see if this updates. Yeah, you know, and I've seen this just in the last hour be in negative territory in the red, and then move back towards a kind of, as you see now, it's kind of minimal in the middle. And that's just what the market does. Mortgage-backed securities, they move with the financial markets. And that's why when you're talking, you know, when we're talking rates with the buyer clients, it's like, that's why I kind of focus on a range of rates, especially with a new buyer, right, who's coming in doing pre-approval. I always show them a trend. And one of the things that I do is I use a software called Mortgage Coach. And it basically, I'll show you an example of it. What I like about it is I can put in 4 scenarios. This is conventional 30-year fixed for a buyer pair, looking at 480,000, and just showing them a range of rates, right? 6, 6 3/8, 6.5, 6 3/4, because you know, from this initial consultation and when I share this with them, you know, we're going to be probably somewhere in the middle as far as market rates go. But that could shift, that could change later that afternoon after talking to them. But I do like the idea of the rate range, just to be realistic and give buyers a sense of kind of what's been going on over the last couple of weeks with market conditions, and then obviously keeping them informed of what financial reports are coming out that could shake up the markets a little bit, whether it's good or bad. But this is a great tool that I like to use to show the rate range. So when I do rates, think of it this way: I never want to send a buyer client away with one sheet of paper with one scenario, with one interest rate, and let them think that they leave thinking, oh, well, that's the rate I'm getting here, right? Well, no, you can get any of these rates. The price of them and the cost is what's going to fluctuate with the financial markets on a day-to-day basis.
Hey, Mike.
Yeah.
Something else. So are you focusing, I mean, I'm thinking all lenders should, but are you also focusing on looking at their credit? Let's say they're at I'm making this up, 730. And 740 means a lower interest rate, as an example.
Yeah, it also that's 740 is a magic tier when you've got a scenario like that where they're 730 and we know it's 740, interest rate pricing is going to be better. PMI cost on conventional loans is going to be better. So yeah, we're running, credit analysis. I think most lenders, unless they're living in the dark ages, whoever their credit vendor is right now, provides kind of a built-in analyzer tool, allows us to do what if scenarios. So in that scenario, if I've got 730 credit score and I know 740 is going to be a benefit to them for rate and PMI, I'll run the what if scenario, right? Or I'll run the analyzer first. And the analyzer is kind of a first run. I basically feed the consumer report, tell them a target range, right? I'll plug in, hey, we want to get to 740. It comes back and it says, it basically spits out a prescription. Pay this credit card down, $200, or pay this loan off or decrease this balance, whatever the case may be. And then we know that if it's that important or dire to that buyer and they have the money and the means to pay that debt down in a reasonable amount of time, we can turn around and do a rapid rescore, get a fresh set of scores for that particular borrower to be able to use to run through automated underwriting and basically to use from that point forward. So yeah, definitely credit is always something that we're looking at, because we know that especially in the conventional loan world, those 20-point increments are definitely the higher you can, the higher you're at, you're going to get better pricing.
So Mike, one more thing. So that's a real tool for agents to know about. Make sure you're working with somebody, with your buyers, because they're all out there getting less than they thought they were going to get, right? To run those calculators to see that it might be worth an extra month or two to secure that better credit rating instead of just rushing into something, because these are really impactful payments.
There's a huge upside when it's a buyer that has a little bit of luxury with time, right? When it's I got to get out of my lease in 30 days and find a house and close, and I got to get my credit score up. That's stressful, right? So yeah, when they've got the time, and I always tell everybody, if you haven't been to the credit class, please come when I do the credit class. We talk about credit improvement and credit fixes. Sometimes they always usually take some time, and they definitely take some money. But these little bumps going from a 730 to 740, that's typically done with a little lowering of a credit card balance and doing a rescore. All right, let me pull.
Hey, Mike, I got a question.
Yeah.
The recent news that's come out in the last couple of months about people that have bad credit are now qualifying for just like people with good credit. What is your opinion on that?
Yeah, so it was May 1st where the Federal Housing Finance Agency basically redid their grid of what we call loan level price adjustments. And it got a lot of, it was funny because they announced it and we knew what the changes were going to be come May 1st, but they announced that back in February. But the media didn't take off and run with it, and obviously until it was enacted on the 1st of May. And they did, at first glance, it does look like they are, subsidizing the and kind of gouging the higher credit score borrowers and the borrowers with the money to put more down, let's say 10%, 15%, that they were getting gouged a little bit, where at the lower credit score ranges, that, you know, they were seeing some improvement. Now, I will tell you, the reality is that where they did the improvements for the lower credit scores, and keep in mind that this is Federal Housing Finance Agency. This is Fannie Freddie, so this is conventional financing. Even at those low 600, 620, sub 640, where they made some of the loan level price adjustments, improvements for those lower score borrowers, they're not a great enough improvement that's going to keep that particular borrower with that credit profile in conventional financing. FHA is always going to be better. So yeah, Darren, a great question. And that it got a little blown out of proportion, I think, media wise. And it did kind of hit the higher FICO scores doing larger down payments. But it didn't really negatively impact higher credit score borrowers that would go in and do a conventional loan of 5% down. And the perks too are for your first-time home buyers doing, you know, with the 3% down. They made some improvements there. So that may have been what you heard. Darren, does that help? Does that?
Yeah, that helps.
Yeah,
I appreciate that.
Yeah, it's definitely, it's something that it happened. It's here. We're living with it, but it's to the lower credit score borrowers, it's lip service to the industry, in my opinion, because they're not going to go conventional anyway. All right. All right, so market news. Just last week, we got an ADP job or blockbuster number, 497 job creations in the private sector. And the reason why this was a blockbuster, and this is where we saw that the interest rate on the website go to 7.22. This was July 6th last week. This really rattled the markets. It hurt the bond market. It hurt the stock market, because when you have an expectation of 220,000 jobs being expected, and then it's basically more than doubled, that really threw the investors in the markets for a whirl on that, for sure. There's a lot of discrepancy between the ADP jobs number and then the jobs report that came out last Friday, where non-farm payrolls increased 209,000, but they were expected 240,000. Now that's, for us, that's a good thing, right? Because that shows what the Fed is doing is working. There's less jobs in the non-farm payrolls, but there's this contradictory report 3 days earlier or 2 days earlier with this blockbuster number. And a lot of this is in how they do the surveys and the modeling. And that's where the mortgage economists, can speak that language way better than I can. But the stuff for us to keep in mind is that, we need to see, and the other thing that hurt there, that second bullet under the jobs report, is the unemployment rate went down a tick from 3.7 to 3.6. So for one of the things that the Fed's watching is they want to see the economy shrink. They want to see these job numbers come down. They want to see wages down. And as you can see, their average hourly earnings increased 0.4% in June and 4.4% from a year ago. And when that's increasing, that is, the markets see that and they're thinking, oh, well, that's more fuel to the Fed's fire, right? That's going to make them continue this hawkish tone about continuing to raise rates. So sadly, we need to see job creation slow down. We need to see unemployment go up, and we need to see earnings subside and decrease. And that will be the signal. And it kind of stinks because it's like you're wishing for bad news, right? but that's kind of what they're trying to do in this rate increase cycle. Now we are sadly one day doing this before tomorrow's consumer price index report, which is probably the second most closely watched inflation report. Now we in the mortgage industry, like the CPI report, put kind of more weight into that inflation readings. The Fed loves the PCE, which is the last bullet point, and that next report, that's the that next report's due on July 28th. And the last one, I had some notes here that the PCE, and keep in mind this would have been for looking back at May. The core rate, which strips out food and energy prices, this is what the Fed loves, this is their favorite measure, only decreased from 4.7 to 4.6. The headline numbers have been really good in these inflation reports, both CPI and PCE, but the core, when you strip out food and energy, that's what's been so stubborn. It's not moving down as quickly. And remember, the Fed's target rate is 2%. So if the previous PCE were at 4.5%, we're a long way off. We're a long way off from that. And I know there's been talks, and if you've been participating in the updates on a monthly basis, a lot of what's driving this inflation stuff is used car sales were a big. A lot of this job creation is in the leisure and hospitality industry, which is just now starting to crest. It's like back to where the levels were before the pandemic, so pre-COVID levels. So the question is well, all right, well, if we're getting back to that, how many more new jobs are really going to be created? So they expect those numbers, numbers to come down. But government added quite a bit of jobs on that ADP report, and they were 60,000, and then healthcare and education was 73,000. So that and the Fed meeting is July 25th and 26th. Right now, actually, that average is bumped up just within the last 24 hours. It's now trending to 93% chance of a 0.25% increase in the federal funds rate at the July meeting. And then that then begins all the speculation, and the buildup is, are they going to do it again in September? Are they going to wait to November? And this is kind of where the markets, bond and stock markets, they kind of been playing chicken with the Fed. They really don't think the Fed's going to do too much more, but it's kind of hard to believe that when we keep seeing the resilient labor market numbers. So it's a month by month thing, which is kind of why we do this monthly update. Any questions on this stuff? I know that's a lot of kind of nerdy market stuff, but that's what this is what's at play. This is what the bond and stock market are looking at. It's what the Fed's looking at to make their decisions. And that, but the problem with the Fed is they're always making decisions by looking in the rearview mirror. And a lot of people feel that they've kind of they've over tightened it, and we haven't seen the total negative impacts of it and what it might do to the economy and possible recession, because that word is still lingering in the background of these economists with each move that the Fed makes.
Hey, Mike, Bruce has a question. Can you speak about Virginia Housing new conventional financing options that rolled up last week?
Yeah, it's right here. It's coming up. All right, Bruce, before we get to that, I think it's your last monthly update. I don't think the Federal Housing Finance Agency set their 2023 area median income updates. That was on June 12th that they went into effect. Now, for those of us in the DC metro area, we look at 80% AMI, 100%, and 120%. Now, 80% AMI is a big deal. That was 112,400. They've now bumped that income limit up to 123,20. What does this, all these bump ups mean? It means more people that fall at or below that income level are going to be able to take advantage of the loan products where they actually remove some of those loan level price adjustments that got such a bad rap in May, when they went into effect at the beginning of May. And that 80% AMI is a big deal because Fannie Mae and Freddie Mac have their Home Ready and Home Possible products. And the great thing about those is you don't have to be a first-time home buyer. You just can't own anything more than the property you're trying to get and one other one to be able to do that. So that's when they raise these income limits, that's helping us qualify more borrowers and getting them in these more preferred incentivized interest rate and lower PMI products. We're a high cost area in the DC market. So that 120% AMI, they've got a product now where they're removing all the loan level price adjustments. And that's helping people right now in that rate range kind of stay in the high sixes, the mid to high sixes, as opposed to, people that make more money. They're the ones that are looking at the 7% and higher rates right now. All right, Bruce, here we go. Virginia housing bond loans, hot off the press. They're so hot off the press that most lenders don't even have them built into our pricing engines yet. This announcement came out of nowhere, but it was a welcomed announcement that Virginia Housing is adding these bond programs, and they're doing it across all types of financing: conventional, FHA, VA, and USDA. Now, what they said to us in their presentation to lenders is that what we're going to see on average a 0.25% lower in rate compared to existing loan products. Now, for those of you that work and have worked with Virginia Housing, first-time buyers and people doing the Grant the Plus program, we know, and we've always said, hey, the trade-off to getting the assistance is that you're going to have an above market interest rate. So this is welcome, because hey, if it's a 0.25% better, we're in an environment right now where we'll take it, right? We'll take it. And it's nice because they also removed on the bond program only. They removed the loan level price adjustments on the conventional loans for the incomes over 80% of the AMI. Now, this only goes up to, though, right? You still have the Virginia Housing household income limits at play for Grant Plus program and their other programs, and now that will be the same for this. But the removal of those LLPAs is awesome. And again, what's it do? It reduces the PMI, and again, we're going to see 0.25% lower in rates. Now, one thing to point out is recapture tax does apply, and you may have heard this. The mortgage credit certificate went away, I think, at the end of May or the end of June. They did away with that. And that had a recapture tax. Now, the same rules apply to this bond program. And that's essentially, if you're dealing with a borrower, and it's more so for the lender, kind of upfront as to whether or not this product's a good fix. If I'm dealing with a client where they're in a line of work where their income could dramatically, increase over the next few years, or at least in the next 9 years, they could be subject to this because their income has exploded. The majority of the people, that doesn't happen, and the Virginia Housing has a website where you can plug in. They kind of do it by county. You can put in put in a county, and I think you can put in a zip code. And it'll tell you, it graphs out the what the incomes would have to be under to be exempt from any recapture tax. But then they put a 9-year term on it too, right? It's like if in the next 9 years your income goes up over our recapture tax calculation, and you sell the home before 9 years and you're making a sizable profit, that's where the tax applies. In fact, they've got, and I'll pull in, let me find my browser real quick. It's a real simple search. Virginia Housing, you just go to their vhda.com and search recapture tax. This little video explains it really well, what it is. Now, it's still referring to the MCC, but the rules of the tax recapture is explained in there. So that's, if you're really dying to know more about it. And the good news too is that these bond programs, you can still do the You can still do the down payment grant, and you can do the plus program, which is the first and second trust for 100% financing. And for credit scores above 680, they can actually roll in 1.5% of the closing costs into that second mortgage on the plus program. That's always been an exceptional program. Any questions about the Virginia housing bond loans? Like I said, it's hot off the press, so we're waiting for it to be built into the pricing engines we're all anxious to test it against the other regular programs to make sure it's actually 0.25% lower in rate. Any questions on that?
Hey, Mike.
Yeah.
Mike, so with this new rollout, our minimum credit score for FHA, is that 640?
Of Virginia housing,
Yes,
620.
620. Okay.
Yeah, the govies are 620, and the conventional minimum is 640 on the reduced MI program. The no MI program has a 660 cutoff, but nobody's really doing that. It's priced out of the market. It's lousy.
Okay.
Yeah.
Okay. And I believe you can still layer other grants like they have in Central Virginia. They have the stepping stone, the stepping stone or stepping up program where they can use Wells Fargo's funds from a local nonprofit to combine that with Virginia housing funding as well. Okay, I just wanted to get that information.
Yeah, the one thing I can't speak to anything Wells Fargo related. I wouldn't know, but the Spark funds that local jurisdictions do, that's all still applicable. And what the great thing about the Spark funds are used to reduce the interest rate a full percent. So if you're, a quarter better on this bond program and you got somebody that fits in and can do like the Spark funds, that's win-win. But yes, other grants can be, one that comes to mind is like at the, I don't know because I haven't seen one where the Federal Home Loan Bank, although I know that money's running out. There was only like 3 million left a couple of weeks ago. So I'm not sure if that one could be in, but I do think anything in your local jurisdictions in the state of Virginia are probably still going to be acceptable.
Thank you.
Yeah. Other things to keep in mind, renovation loans, on the agent side too, especially if you're working with sellers, they don't want to put any money into the property. Always keep that maybe in mind as a marketing technique and a strategy to maybe do a renovation loan. See a lot of move up buyers utilizing bridge loans. They are expensive, or utilizing home equity lines of credit to help move up buyers, right? To basically tap the equity in the current house to be able to, to do the down payment on the next house on a short-term bridge loan that we know is going to pay off when they sell the departing residence. But that's just some good, talking points, things to keep in mind and not forget that those products are out there. All right.
Hey, can I say something to the agents?
Yeah.
Guys, these resources, like renovation loans, like bridge loans, this creates inventory. We kind of have a problem with a shortage. So, if you want to create some inventory, that's the kind of stuff you want to do. Think out of the box. That's what I used to do. It really works.
Cindy, you teed it up nicely because these insight bullet points are all about, or most of them are about kind of the inventory struggle that we have. Came across two terms, accidental landlords and house hostages. Your accidental landlords are the people that they want to do the move up buy, and in order to do that, they're going to keep the other residents and convert it to an investment property, even though they might not want to. But more so, you have house hostages. And the reason for that is 63% of the mortgaged homes have an interest rate of less than 4%. And kind of what Cindy's getting at is right. It's where our jobs in this industry are to find those niche products or those opportunities or those conversation starters. Because you've got a lot of people right now, less than 4% on a mortgage, that don't want to trade up and pay 6.5. So what are they doing? They're not reaching out to you, right? They're not interested in selling because they have this idea of like, well, I'm just going to wait for rates to drop. And the rates are going to drop at some point, but there's some flawed thinking, and sometimes it's a data crunch, and you need a lender to kind of help you with it, where we can look at the scenario of, hey, is it really that bad if you sell and can put this much more money down on the move up buy and go from a 4% rate to 6.25 or 6.5? And we've got, the lenders have the tools to kind of help you show that mathematical education, if you will, because oftentimes, the larger down payment on the next house gets them relatively close, or within reason to the payment that they've had, because they're able to do a larger down payment this time around as opposed to, a first time buy. I was interesting, a couple of these points come from, I put it in parentheses down there. The resource.tv would be another website, and I'll show it to you in the browser here in a second. That they had a video run, and it's great because they give you all these talking points, then we can take, and we can, there's no copyright on any of this stuff, right? You take this information, they want you to share it on social media and put it in front of your real estate partners. And one thing that they did a video on was there was a survey of 93% of home buyers have regrets, right? So there's potential opportunity in that adversity. One of the things they talked about was during the pandemic, what happened? Everybody wanted out of the city, right? And they go out into the city, and now they're no longer working remotely. The employer tells them they got to go back to work, and now they're commuting, and they hate life because they're commuting. And now you've got this mindset shifting back to like, oh, maybe being in the city or being close to my job, in a metropolitan area isn't such a bad idea. So there might be, and I think that's part of the regrets. But they go into some other really neat details and some of the data collected from some of those surveys. The other one they did was one real estate agent leaves the business every 3 minutes and 37 seconds, right? So here's your opportunity to pick up market share, right? Continue to grind and survive and pick up market share, because I think they said 60,000 agents in the United States left, whether it was around the February timeframe or since February. And the video has got some really good information on, what that 60,000 is in proportion to the total number of agents. Another report came out that, we need 4.3 million homes to meet the demand of household formations. Household formations are, I think it was like 7.9. I mean, they're far outpaced, 7.9 million household formations, I think, have occurred. I think they went back to like maybe the meltdown of 2008 is where they're collecting some of this data. And we're at a shortage of 4.3 million homes to meet that demand. Some things that for us to think about. Let me show you. I do think this is worth checking out. There's my tab for it. Yeah, Resource TV, right? And I think they do at least here videos. They do like a weekly, sometimes two, maybe sometimes 2 a week. But they put out some really good research, really good data. And again, all of this stuff is stuff that you can snag and post it on your socials, and any of you do blogs or anything like that, get the word out. But they've got some really good information. As you can see by the recent headlines, it does right. It's all this bad news, right? Another week, another record low, talking about, sales being down. And that's the other thing too, is you can go on and look at your, here's PWARs. Now, again, these are May's numbers, right? With listings, median sold price, closed sales, active listings. As you can see, price is up a little bit in average days on the market. Is up 100% because it was six days last year. So this year-over-year numbers for May, that's PWAR Prince William. I believe this is Fairfax's. Again, what a drastic difference in median price. But I mean, we've got homes sold. We're recognizing, again, more reason to have these conversation starters. Reach out to your past clients. And have some of these conversations, because you got a lot of potential move up buyers, repeat business. They just don't know. They lack the education, because they're listening to the media and in the doom and gloom, and they're not looking at numbers. They're not looking at data and seeing some of the upside benefits of making that move up, buying the long-term wealth creation from owning that real estate.
Hey, Mike,
Yeah,
can we just circle back with Virginia Housing Program, the funding? As you referenced, the Spark funds, which allow you to reduce the interest rate. In essence, you could extrapolate, you're allowed to have more purchasing power with the combination of some of these programs. Is that a fair assessment?
absolutely. If you think of it, it's pretty cut and dry. If you have the ability to lower the interest rate, you're lowering the debt to income ratio, right? And you're lowering the payment to the borrower. So yeah, when these programs can be stacked, that to me, the new bond programs, I think are going to be great. Because my concern was initially that if they did something, that they wouldn't allow the grant and the plus program to be part of that. And the fact that they're included, I mean, that's awesome, because those programs are great. Yeah, we've got these good programs in Virginia. For anybody that does business in Maryland, you've got the Maryland mortgage program. But I'm in Virginia. I know a lot of you are. I've always said this. I've never been shy about this, but Virginia Housing, hands down, has the best down payment assistance, in my opinion, in our region.
Thank you.
Yeah. Anything else, Bruce?
I'm good. Thanks, Mike.
Sure thing. Well, guys, that's all I have to share for you. Are there any questions? Anything you're wondering about? If I don't know the answer, I'll get it for you.
I just hope everybody heard about the opportunities you have to create inventory, because there's lots of opportunity. I'm one of those house hostages, 2.7%, don't want to move, oodles of equity, can't get anything, been looking, because where I'm going is downsizing. So that means it's a much lower, my house will sell for 1.3 million and I'm going to be, going down. And so is everybody else, so it's a real problem. But, these options are really good to know, but you guys should be using it as a tool, because people are just exactly like Mike said. I hear them talking. I have friends and stuff. Oh, I can't do this. I can't do that. The media says, get them to Mike, sit him down, let him do the job. They got to get educated. They're so dumb. They really don't understand.
Yeah, they're either misinformed or they lack the education behind it entirely at times. And, you know, and I always tell everybody, like, it doesn't cost you anything to take a look and explore it. And I always tell, especially in the move up scenario, like, if this isn't going to work, or this isn't a good financial move for you, I'm going to tell you that. Right. But yeah, we need them to we need to help move them and shift the mindset that it's worth exploring. And but I get it, you know, that's the problem, right? You get a lot of people that say, I'd love to sell, but what am I going to buy?
Well, that's really the problem, and I'm living it. So I'm just going to stay here with Daisy Deer and be done with it. You know what I mean? I'm exhausted from also seeing a lot of stuff that's on the market that's garbage. I'm
Yeah.
not buying something so I can put $200,000 in it because somebody didn't take care of it because they think it's 2 years ago,
Mhm.
literally.
Yeah.
And I saw one yesterday that made my toes fall off. I said, you have got to be kidding me. I said, I'm thinking to myself, why did this agent even list this house? You know, and it's just very, very sad. So it is also exhausting. Okay. Especially if you're downsizing, unless you're going to a 55 and up community that's, you know, where you can buy new, but then you're probably overpaying, right? So, but I think they should just sit people down with you. I think this is really good information. And by the way, I'm putting this on Mike's instructor page at cindybishopworldwide.com. This was loaded with good information that I know really gave me some ideas because I'm in this situation, you know? And so I understand. I thought it was so funny you said a house hostage. It's hilarious. That's
Well,
how
and
I feel.
I really thought, you know, if 93% of the home buyers have regrets, we just helped them buy in the last couple of years. And yeah, maybe, you know, some of the regret, because I've heard it from my own clients, is, you know, they feel like they overpaid for their house,
Mhm.
you know. But I think the past client, the database is our gold mine, and we have to be in it.
And they need to be educated. You guys need to be educating them because they really don't know. They really, really don't. I went into a 55 and up community yesterday because I don't usually frequent those because I have more energy than most 20-year-olds. So I don't see that as a place for me to go. At least that's in my mind, although they had a beautiful clubhouse. Oh my God. Nobody had a fence. What happens if you have a dog? Right. So that was something I learned. I said, wow, I'm sure that's not all of them, but you know, it's really important to get them out there because there's so many people in my position where they really want to do something else. So there's a good market right there. You know, I don't know how many people
Because
want
they
to,
cut the grass.
but was that how they cut the grass? Well, my
That's
animals
what
are more important to me. So yeah, and I like cutting the grass. I have a rule when I move, my John Deere's going with me, man. I love my yard. And that's the real issue to leaving it because I love it. And I have an acre and a half. It's not much, but it's just mine. I love it. And I built this oasis and I have a pond and I just love it all. And I'm even happier looking on my John Deere when I've got my cart attached to it with my little hat.
I
Yeah.
don't know. I
Hey,
don't know if Cindy saw my post the other day.
Uh-uh.
I sit a little bit over an acre, 1.7, but
Mhm.
I still push cut my grass, y'all.
Do you really get yourself a John Deere? I'm telling you
I-
what, that is the
Cindy,
greatest thing.
Cindy, I just love the lines. So
no
I love
thanks. I'm on a quarter acre pushing that thing, and that's good enough for me.
Oh, you're not kidding me. I have a push mower just for edges and stuff, and it does a better job cutting than my John Deere. But I have asthma. I just get out of breath. I don't think the air quality is very good. And so I'm a very happy face, big happy face when I'm with my John Deere. So,
Hey, Mike, I did have a tough question for you, and this is a tough question. Sydney brought up, you know, new construction. So when we do new construction, a lot of times with your production builders, they will offer incentives provided you work with their mortgage side. So when those incentives are offered and you know, client doesn't have to use their attorney or settlement agent, but they lack the closing cost assistance. Do you have any takes or thoughts on how we can counter? You know, DR Horton is offering a lot of incentives as well.
Yeah, I mean, what exactly is the question, Bruce? Like what, I'm sorry.
What's a means of countering when the builder, the production builder offers
Did you say
15,000
to counter the,
or to say, hey, you know, my client has been pre-qualified with Mike Ott, and they want to stay with Mike.
yeah, I'll give you my perspective on it. And because I'm with First Heritage Mortgage. We're owned by Stanley Martin. We are the in-house lender, right? So the incentives are tied to the buyers, you know, using our services along with the title company. So I get it, but I also lose clients and I lose deals when they go to a different builder, because the incentives right now, a lot of these, like a couple of the neighborhoods that we have with Stanley Martin, they're doing 15,000, 20,000 in credit. And that's hard, you know, when you've got a client that's pre-approved somewhere, but then they fall in love with the builder home. You know, I always, when I'm in the position where it's my client and they go to a different builder, I always tell them, like, don't kick me to the curb, right? Because a lot of times you know, I might be able to put together better financing for you in lieu of the credit, but the credit dollar amounts are really high right now. And I'll be the first one to tell a buyer client of mine that goes to a different builder, like, you got to take that money. I'll help you refinance when the rates drop.
Okay.
Yeah,
Thank you.
I mean, it's one of those, it is what it is. I've never been a big fan of it, but I'm also working for a company that's kind of involved in it, if you know what I mean.
Over the years, I'll tell you what, I never found that to be good lending. And what I mean by that is, on the surface, it may sound great, bells and whistles, but at the end of the day, it's assembly line lending that doesn't give a rat's toot about the buyer. They're just trying to get kickbacks. And I just think it's a real violation.
That's the thing. I've always had like this. How is this not a RESPA violation?
Yeah, it is a RESPA violation, but you know, they're not governed by the same rules. So I just always had a problem with it. I used to make my buyers sign addendums saying that I was released of all liability, because I just felt that they were just shysters. Okay. And I just think that I didn't think it was in the best interest of the buyer. I think you always need somebody to yell at. And most of those lenders, I mean, it's good to hear that you guys do one of them, because you guys are great, but not everybody is. A lot of times it's just these lenders that have just sprouted up, and, you know, they're just kind of like, you know, I always say, don't use Navy, Federal, USAA. I'm customers of both, but you have no one person to yell at. And you may not have people that are really experienced. So you've really got to shop around and know who you're dealing with. This is a big purchase, you know, you got to make sure you're protected. And I don't think people do. I think they just look at these bells and whistles and drool, you know, it's just, and foam at the mouth. I think it's just lack of education anyway. But Mike, thanks. Wonderful. I remember, guys, I'm going to put this replay once it's ready later. I'm going to put it on his instructor page on our cindybishopworldwide.com site. And to get there, you just go to the upcoming events portion of that. If any of you have been in there to sign up for classes, and then down to the right, there's a button that says meet our instructors, and you'll find them that way. So, okie dokie.
Thank you, guys.
Have a great day, everybody.
See ya.
Okay, bye.
Thank you.